So in the previous video, we discussed about favorable financial leverage. Now we're discussing about unfavorable financial leverage. All situations remain the same except for earning before interest and taxes, which has now become 2 lakh of rupees. Earning before interest and taxes and earning per share, this is the analysis which we are going to do again, but unfavorable financial leverage. Why? Because we have why I'll answer later on. Here we have, suppose this is company Y limited, it has total fund of 30 lakh, interest rate is 10% per annum, tax rate is 30%, earning before interest and taxes 2 lakh. This is the change which is now happening. Three situations are there. First one is with no debt, second one is with debt 10 lakh, third is debt 20 lakh, and equity share at the rate of 10 rupees per share. Condition for financial leverage is that the same as rate of return is more than the rate of interest, and second is interest is tax deductible expense. The same thing remains whatever the question was, except for the earning for interest and taxes is 2 lakh. Now situation 1, 2 and 3, here 30 lakh, here 20 plus 10, that is 20 is equity, 10 is debt. Here 10 plus 20, here 10 is equity and 20 is debt. Then earning before interest and taxes in all the three cases is 2 lakh out here. Interest is nil in the first case because on equity we don't pay any interest. On when we talk about the second situation where debt is 10 lakh at the rate of 10%, we pay 1 lakh as interest. Then in the third case where debt is 20 lakh, 10%, we pay 2 lakh as interest. Now what we have is earning before tax. Here it is 2 lakh, here it is 1 lakh, and here it is nil. Why? Because 2 lakh we have paid as interest. Now tax is 60,000 out here, 30,000 here. Since we don't have any profits, we won't pay any taxes out here. This is one situation we are considering. Earning after taxes or earning after interest and taxes, out here we have 1,40,000, here we have 70,000, here it is again nil. Earning per share, the formula goes earning after interest and taxes or an earning after taxes upon number of equity shares. This is 1,40,000. 30 lakh के equity है, the equity is for 30 lakh, 10 rupees का एक शेयर है, so 3 lakh के number of equity shares कितने हो गए? 3 lakh हो गए. यहाँ पर 70,000 by 2 lakh and either we have nil upon 1 lakh. Now 0.47, 0.35 and nil. Here earning per share of the company is falling with increased use of debt because why? Return on investment, that is earning before interest and taxes 2 लाख रुपए. अगर हम इसकी बात करें इस वाले 2 लाख की, we are talking about this 2 lakh. Earning before interest and taxes upon total investment, that is 2 lakh by 30 lakh into 100 is 6.67. So here return on investment is what? Less than the interest. Interest is 10% and return on investment is 6.67%. So here return is less and rate of interest is more. In such case, use of debt decreases the earning per share. Now how do we define that? How it does like this? Because here return on investment is 6.67 and interest is 10%. So what is happening? Because return on investment, that is profit, is less and interest is more. So what is happening? Earning per share is decreasing. Earning per share is decreasing. Whenever here we don't use debt, earning per share is not decreasing, but in both the cases it is decreasing. Now comparatively, if we take it to the favorable financial leverage, this is lesser, but with use of more debt, when we are saying using of debt out here is not a very good idea. Conclusion: a company must choose that risk-return combination which maximizes shareholders' wealth. That means debt and equity mix should be such that you achieve optimal capital structure, and that can only happen when you have more rate of return, that is return on investment, and lesser rate of interest. Of course, 13.33 is easier or a better rate of return to pay off 10% rate of interest than 6.67. So anyways, this is unfavorable financial leverage, and a previous example was of favorable financial leverage. After the comparative analysis, we would conclude that favorable financial leverage is better than the unfavorable one. Hence, we conclude that favorable financial leverage is better than the unfavorable financial leverage. I would like to just lay little emphasis on how it is better, I have already given example of making it comparative analysis with the 10 people. See, in a firm, if 10 people invest in equity and they invest 10 rupees, each will get 10 rupees. Out of 10 rupees, 1 rupee each as rate of return. But if same thing is divided between people having debt and equity, the people who have invested in the company as the debenture holders or who's lended the money to the company will have fixed rate of return, and the leftover which goes to the equity shareholders will always be more. This is what is a basic funda about financial leverage, or when we talk about the favorable financial leverage, this is what we are trying to say, that earning per share for the equity shareholder increases when we employ debt along with equity, the mix of debt and equity, but debt should be in a limit, and also the condition, the first condition, that rate of return should be more than the rate of interest. So next we go on to is the factors affecting capital structure. This too shall pass. So we have been talking about capital structure, and we did the definition part of it. We did financial financial leverage. We did favorable, unfavorable financial leverage. We did numerical also, the only topic which has numerical in business studies. And now we're coming to the factors affecting capital structure. Now the first factor which we are going to talk about is cash flow position. Very simple. You must have enough cash inflows first to meet your fixed asset or fixed capital requirement, your day-to-day expenses, as well as your debt service coverage commitment. Debt service coverage commitment or debt service commitment means what? That you are able to pay the interest as well as repayment obligation. So if you have enough cash flows and you have kept some money as buffer means to meet the unforeseen circumstances, something like provision. So if you have enough of cash flows and you've kept some as buffer and you're able to cover all these things, please borrow from the market, otherwise please avoid. Why? Because capital structure we're talking about is mix of debt and equity. So will we consider debt or not? Yes, if we have enough of cash flows, debt can be considered, provided your cash flow must consider fixed cash payment obligation along with buffer also. It must be kept in mind that company has cash payment obligations for normal business operation, for investment in fixed asset, for meeting the debt service commitment, that is payment of interest and repayment of principal amount. Second point we are going to talk about is interest coverage ratio. Interest coverage ratio means that how much is your earning that you can actually cover your interest. I'll give you an example out here. I've given a formula out here. Interest coverage ratio means earning before interest and taxes upon interest. Suppose your earning before interest and taxes upon interest is, your earning before interest and taxes, let's suppose, is 20,000 and your interest is 5,000. So what is the ratio? 5 4s are 20, 4 is to 1. That means what? Out of 4 rupees you have to pay interest 1 rupee. Palatable, happy. The interest coverage ratio refers to the number of times earning before interest and taxes of a company covers the interest obligation, exactly the same. Let's consider another situation. Here, suppose earning before interest and taxes is what? 20,000 and you have to pay interest of 1 lakh. Okay, let's consider the ratio. 2 is to 10, 1 is to 5. Out of 1 rupee of earning, how will you pay 5 rupees as interest? Not feasible? Exactly. This is what interest coverage ratio talks about. So if interest coverage ratio is more, that means your earning before interest and taxes is more and you can cover more interest, that can be considered. But if interest coverage ratio is less, that is not considered. Interest coverage ratio is more, that is lowers the risk of company failing to meet its interest payment obligation. Only limitation of interest coverage ratio is that it does not consider the repayment obligation, and whosoever is lending you money will always want the principal amount back. So next we talk about is debt service coverage ratio. Debt service coverage ratio considers the limitation of interest coverage ratio. That means it talks about what? It talks about interest as well as principal amount repayment obligation. The debt service coverage ratio takes care of deficiencies in interest coverage ratio. What does it talk about? The cash profits generated, the money which you get, the cash by operations, that is cash inflows, are compared with the total cash required for service of debt. Service of debt here means one, interest, second, repayment obligation, and third, it means the fixed preference share capital dividend and the preference share capital dividend. It is calculated as follows: profit after tax plus depreciation plus interest plus non-cash expenses, other non-cash expenses, preference dividend plus interest upon repayment or plus repayment obligation. This is divided by it. So this is how you calculate debt service coverage ratio. So if debt service coverage ratio is more, you have better ability to meet cash commitments, debt can be considered. But if it is less, please do not consider debt. Why? Because when you do not have enough cash from operations, how will you meet all these commitments of your own? So we've talked about 3 points: cash flow, interest coverage ratio, and debt service coverage ratio. Factor we talk about is cost of debt. Now, when we talk about capital structure, cost of debt is to be considered. Debt is a cheaper source of finance. So fixed rate of interest makes it cheaper, and tax deductibility on that rate of interest or that interest, when interest is treated as an expenditure and that it decreases the tax liability, it is considered better. Now, if you have lower rate of debt or you have higher rate of debt. So if you have lower or cheaper rate of debt, that rate can be considered because it increases the firm's capacity to borrow. But when the debt is expensive, please, we do not want to consider debt. We may consider equity or may not, that is a different choice. But here we are talking about mix of debt and equity. Equity we already have. We are talking about mix of how much, what percentage of debt shall we get. So in consideration for cost of debt, when it's cheaper, then only we get it. Next is tax rate. So when we talk about tax rate, what are we highlighting at? We are talking about tax rate is higher or tax rate is lower. Now, when tax rate is higher, higher tax rate makes debt cheaper. Why higher tax rate makes debt cheaper? Now, interest we've already done the capital structure, favorable financial leverage. You have interest. If the interest, after deducting interest, whatever you get, you have tax. If the tax is higher, you have comparatively the amount left to be distributed to the dividend as dividend to the equity shareholders. That amount, when distributed to the equity shareholders, comparatively is left over and becomes more. So what happens is, since debt is treated as a deductible expense, so it says higher tax rate makes debt cheaper. Interest is tax deductible expense. For example, firms are borrowing at the rate of 10%. We know that and we've done it in the example. Tax rate is 30%. So after tax, cost of debt is 7%. It's as simple as that. If you are borrowing it is like this. If we are borrowing at 10%, we take rupees tax as 30%. So 30% will be 3 rupees, and after tax, cost of the debt will be 7%. This is what they are talking about in tax rate. So we'll just talk about it. Cost of debt. So if you have lower rate, then only debt can be considered out here. Here it is a lower rate. Okay, if the tax rate is zyada, it is higher, debt can be considered. Second point. Next point is flotation cost. Now, here are 3 things which we need to know. First, the meaning of flotation cost. So process of raising resources also involves some cost. We know it that some kind of cost is resources involves some cost, some kind of cost is involved here. Public issue of shares and debentures also includes some kind of cost. So it includes kharcha out here also, again a kharcha. Getting loan from financial institution may not cost much, but it's a lengthy process. It takes some time to get loan from financial institution, and there are some clauses, restrictive clauses which are there. So if flotation cost is high, please don't consider debt because that will add up to your paying back of interest. It's not a good idea. It will increase your expenditure, but if flotation cost is less, debt can be considered. you can consider debt as one of the source of finance. So this we are talking in terms, I'm emphasizing, we are not talking about equity, we are talking about when can we consider debt out here. Now, flexibility. Like in a class, if you are in a class or in your circle, if you have a friend who keeps on asking for money every time, so whenever you will see him next, you will just tell yourself or your other friends, let's run away from here, that man is again coming to borrow money. He's always borrowing money from us. Same happens with the firm. If firm keeps on borrowing continuously, it loses its flexibility to borrow more, and in the time of unforeseen circumstances, when firm is unable to borrow, it will become a problem. So, if a firm uses its debt potential to full, it loses its flexibility to issue further debt. So, you should not use your potential to full. Potential to full. If you use a firm uses a potential to full, it loses. It loses means people would not further lend you money. So, debt raised up to maximum, or debt raised in limit. If it is in limit, debt can be considered in unforeseen times, because people will be ready to lend you money, but otherwise they would not. So again, we are considering cost of debt, tax rate, flotation cost, and flexibility. Next we come to is control. Now, we know it very clearly when we talk about debt and equity. We talk of debt and equity. Debenture holders have no right to vote, no right to control, and they have no threat of takeover. Why? Because we have to pay them their interest, whatever it is. Either we have to borrow from somewhere else, we have to pay them. Yes, they don't have the threat of takeover, but they have a threat of insolvency. They can declare you insolvent. So we never go to that extent. Whereas equity has a right to vote, right to control. So here they have no right to vote, no right to control. Here they have right to vote, right to control. So what happens is they have no threat of takeover here, but we have a threat of takeover. How does threat of takeover comes over with control? Because when outside equity becomes more than the inside equity. Like for example, if we want more money and we don't want to include more people for those who are like lending money to us, we don't want too much of debt. So we ask for equity shareholders. Equity shareholders are some people who agree to buy the equity shares of the company. Maybe their equity shares could be could be more than the already existing equity shareholders. So what happens is when their equity shares are more than the existing equity shareholders, it leads to dilution of control, because outside equity becomes more and inside equity becomes less. So it leads to dilution of control and watering of equity. Debt can be considered. Why? Because there is no dilution of control. Last point is stock market conditions. For this board, last point is stock market condition. See, when can debt or equity can be raised? Debt or equity can be raised the time when we talk about the market being bearish or bullish. Now, when is the stock market bearish and when is the stock market bullish? Okay, when shares price is rising, stock market is bullish. Like a bull puts its victim on the its horns and throws it in the air. Similarly, in a bullish phase, the price of the equity goes very high. People love to buy equity shares. They just simply love to buy equity shares, because even at a higher price, they know, because ultimately the price of the equity share are going to increase, and when they increase, the people like to sell it, and that's a kind of an investment process. So bullish phase, people like to buy equity, but in bearish phase, people know, like a bear, it thumbs its victim and stumps it down to the floor. Similarly, the price of the equity goes down so badly, the market is not in good condition. People prefer to buy debt or debentures. Why? Because they know at least nothing else, they will get the fixed rate of interest. So debt is considered in bearish phase as no one is ready to buy equity, therefore debt can be preferred. But equity is considered under bullish phase as equity can be easily sold, sometimes even at a higher price. So this is about the 9 points of capital structure. We have total 14 points. So we'll do in the next board the rest of the points. All right, next we're going to talk about is return on investment. When return of investment, when we talked about financial leverage, we talked about two things, favorable and unfavorable financial leverage. So we talked about return on investment. There were two conditions. One, that return on investment, that is profit, should be more than the rate of interest. In case it is more, it is favorable financial leverage. In case if return on investment, that is profit, is less and the rate of interest is more, it is unfavorable financial leverage. Now, again, we're talking about the same thing. If you have favorable financial leverage, like when we had, so here what is it, that return is more than the interest, and in this case return is less than the interest. Here in the example when we did, it was 13.66% and interest was 10%. Here return was 6.67% and the interest was again 10%. So this is called unfavorable financial leverage, this is called favorable financial leverage. Again, if return on investment is more, the favorable financial leverage, firm can use trading on equity and can use debt. More debt can be considered in comparison to unfavorable financial leverage. So if in case it is unfavorable financial leverage, we prefer total equity. All right. Return on investment is an important determinant of companies' ability to use trading on equity, thus the capital structure. So that's how you decide about your capital structure, how you're getting your returns. Next is cost of equity. Now, when we talk about cost of equity and cost of debt, we always say debt is a cheaper source of finance. So how do we consider the cost of equity? See, debt is a cheaper source of finance, but if we take excess of debt, it will increase our financial risk because there would be risk of default on payment of interest as well as repayment of principal amount. So that kind of financial risk will always be there. Now, rate of return may increase, the earning per share may increase. Of course, yes, there is rate of return for the equity shareholder may increase, but ultimately the share price would decrease because I always say, if your financial risk is increasing, that means there is somewhere there that you are unable to pay off your interest obligation. That means the equity shareholders are incapable of paying off to the debenture holders. So, and debt use up to a level, what does it do? It leads to maximization of owner's wealth because financial risk is not there. Then rate of return is, though it is increasing, and it leads to increase of earning per share. Along with that, also share price does not decrease. So debt can only be considered in case when debt is used up to a level. Beyond that, debt cannot be used. Excessive use of debt leads to financial risks. And financial risk is not a very good idea for any kind of business firm. Risk consideration. Now you'd say, ma'am, cost of equity, you're talking about financial risk, and then again in risk consideration, you're talking about the risk word. What exactly are you trying to say? When we talk about cost of equity, we say that cost of equity gets affected when debt is used beyond a limit. What will happen is that if you use excessive of debt, then the equity cannot be enough to pay off the debt, and that poses a threat. Here we are talking only of the risks. What risk are we considering? Financial risk and business risk. Financial risk is default of when you have a default of payment of interest or principal amount, and business risk is risk of operating cost, the cost of doing business. Now, both are to be considered before choosing debt or equity. Before choosing debt or equity, you have to consider both financial risk as well as the business risk. Therefore, debt can be considered if there is lower business risk and lower financial risk. Very true. If your cost of your operating cost or any kind of cost is less, debt is preferred. Why? खर्चा कम है ना, तो अगर इंटरेस्ट आ भी रहा है तो अगर हमें इंटरेस्ट देना ही पड़ रहा है तो कोई दिक्कत नहीं है. लेकिन अगर खर्चा ज़्यादा हो जाएगा, then it will be a problem. And same is with the financial risk. So financial risk, if it is less, that means there is no default of payment. You can anytime consider debt, right? Next, regulatory framework. Now, debt and equity, the choice depends upon the regulatory framework. Why? Because every company has to work according to the regulatory framework given by the Companies Act 2013, according to that act. Now, the first thing is public issue of shares and debentures has to be made under SEBI guidelines. So we know Security Exchange Board of India plays a very important role. Second, raising funds from banks and other norms. Now, raising from banks, financial institutions, all they have different types of norms. Therefore, debt can be considered when SEBI is flexible and banks go easy on loans, which never happens. So we always prefer equity with regulatory framework. And if we can fulfill the right kind of regulatory framework given by the SEBI, you can go in for debt, no problem at all. So if SEBI is flexible enough to give you the right kind of exposure to borrow from market, you can go ahead and do it. But otherwise, no. Of course, when there is a bearish phase, this happens. Capital structure of companies, other companies. See, you have a choice. You can choose your own capital structure, debt and equity mix. You can take it of the same as your competitor, or you can have more, or you can have less, whatever is your choice. It's your choice in totality. But please keep few things in mind. And what are those few things? Debt or equity, a useful guidelines in choosing capital structure planning is debt plus equity mix of other companies in the same industry. So you can consider other companies, but you can consider same industries. Industry norms can also be considered. So you have to see that what industry norms are. See, your business has more business risk, right? Operating cost, because you've just started. And there is another business which is established for last 40 years. You can't make a comparison with that business and their proportion of or their mix of debt and equity. You have to consider your own mix. So debt can be considered keeping business risk, financial risk and industrial norms in mind. These were the factors affecting capital structure. Whenever the choice of capital structure is made, these are the factors to be considered. Before winding off the topic capital structure, I would like to emphasize on trading on equity, two conditions, and what exactly is the use of trading on equity in capital structure. Alright, this is a kind of a treat for you people. I'm telling you about trading on equity. What is trading on equity? Many times people use it as a synonym for financial leverage. When you have to write a particular definition for trading on equity, okay, you will write it as trading on equity refers to the increase in profit earned by the equity shareholders due to the presence of fixed financial charges like interest. This is the definition for trading on equity. The two conditions for trading on equity are return of investment should be more than the rate of interest, and interest is a tax deductible expense. So these are the two conditions to be used. Now, this is same as the conditions to be used in financial leverage. Again, coming on to why do we use trading on equity? Because debt as a cheaper source of finance is better. So I've written here debt as a cheaper source of finance is always better, and it leads to increase. It helps to increase in earning per share. So that is why we use trading on equity. Like I told you, you see a seesaw. Whenever this side if you have equity, this side if you have debt. So whenever you will use debt, there will be an increase in earning per share like this. Debt works as a lever to increase the earning per share of the equity share holders. So helps in increase of earning per share. When it is to be used, when return on investment is more than the rate of interest and interest is tax deductible, same. And how it is to be used, you have to explain the example of financial leverage. So only for the basic definition part of trading on equity and financial leverage, a little change has to be done. Otherwise, rest of the topic, it literally means the same. There is hardly any difference. In simple colloquial terms, it means that whenever debt is used as a lever, it leads to increasing earning per share of the equity shareholders, and debt with fixed financial charges, that is fixed rate of interest, and a cheaper as a cheaper source of finance. So we finish off with capital structure. It was a big topic and I think we need to celebrate. So I'm doing ta-da! Enjoy yourself watching this video. See you in the next video with working capital and fixed capital.